Good morning, everyone. This is Financial Literacy 101. And this morning, we will be discussing call options. We're going to get into the weeds about call option. We're going to even cover how you can cover your option when it comes to and pertains to writing an option. So we're going to deconstruct this. We're going to break this down so you guys can understand. And absolutely, I believe this is the best way to invest, especially if you don't even have that much money. All right, let's get right into it, ladies and gentlemen. So first and foremost, the question that most people have, a buddy of mine sparked this discussion this morning and basically wanted to know all about options. So essentially, what is a call option? A call option is essentially a financial contract that gives the option buyer, you in most cases, the right but not the obligation to buy a stock, bond, commodity, or other assets at a specified price within a specified time period. Now, that stock, bond, commodity, you also hear different terminology. It is also called a underlying asset, but most people just say stocks, okay? Now, a call buyer profits when the underlying asset increase in price. So when that stock increase in price, that is where your profit starts to build, okay? So a call option may be in contrast with a put option, what gives the holder the right to sell the underlying asset, aka stock, at a specified price on or before the expiration date. So let me share my screen with you guys so you know essentially exactly what I'm talking about, so we can look at this together, okay? So let's break this down the best way that I know how. So if you're noticing at the top left of the screen right here, this is the current price of the stock. This is the current percentage of the stock. And if you notice, I have a call option for $14. And I bought a call option at the fraction of a price at $2.15. That's where it's currently at, the projected price. Now, as I go down and I look at all the information here, the cost for this was $490 because the stock has decreased in price. So did my market value. What is also pertinent to this? The expiration date. My expiration date is September 17th. Okay. And I bought 2 contracts. The average price per share was $2.45. So the way that they actually do this is when you're buying an option, whatever number you see, it's times 100. So let me give you an example. Let's take, for instance, I wanted to buy a option. Let's see if this is an option here. We go to trade options. And if you notice, it gives me the price per 100. It gives me the stock, Genius. It says buy or sell. So since we're buying and not selling a call option, then you also have call and put. So essentially, when you're looking at call options, you see that is in green. If I turn to put, it turns to red because I'm essentially predicting that the price of that stock will go down. So since we're talking about call option, I'll just stay here. The next important thing is, when is your option expiring? So this one says May 21st. Okay, that's only a month out. That could be considered a short options. So long options is where you want to be safe. You want to have time for that particular stock to increase and decrease in value. So essentially, I tell people at least 3 months you want this option to grow. So we're in May, June, July. So let's just go with August. But when you do this, options are not going to be cheap. They're going to be very, very expensive. Okay, they're going to be very, very expensive. But nonetheless, this is where the money is. So essentially, the current stock price is $2.95. Now, because I have an expiration date of August 20th, the most expensive option, as you see here, is $1.85. Now, this is primarily the safest option because the stock price is already at $2.95. Okay, so you see right here at this particular price point, It says to break even, and we understand the break even, right? We understand what a break even is. So breaking even in option trading is the price in the underlying asset, which is the stock, at which investors can choose to exercise or dispose of the contract without incurring a loss. Okay. So essentially, you have plus here and you have minus. So, me personally, I will go with this particular option. Now, like I told you before, anytime you see the fraction of a cost of this particular option at $1.20, you times that times 100, not 10. So if I buy one option, it's $120, okay? Because you're times 10 in it, times 100, and then you bought two, that would be 240, okay? So essentially, let's take, for instance, let me see if I have any money to execute this particular option. Let me see if Robinhood will let me deposit any funds here. Let's wait for a second here. Wait till my buying power actually populates. There it is. I'm going to execute this option. All right. I'm going to refresh my screen. Go over to a Genius. And if you notice, okay, refresh. Okay, because the market is not live, it did not execute. But once the market comes live, that option will execute. Okay. So I just wanted to break that down to you very quickly before we get into the heart of the matter. So if you have pen, paper, you have your phone notes, please take this information down. It's going to be very, very viable for your option trading education. Okay. So let's get into it, ladies and gentlemen. Please listen. So these are some of the things I'm going to cover. A call option is a contract giving the owner the right, but not the obligation, to buy a specified amount of a stock security at a specified price within a specific time. That's basically what a call option is. Buying a stock at a particular price with an expiration date and banking on the accumulation and value of that stock increasing in dollar amount, which is profit, before the expiration date. Now, briefly, I'm also going to cover what they call time decay. And basically, time decay is based upon the Greeks, mainly the theta. The closer you get to the expiration date of an option, you will see the profit, you will see the value of that option decrease. So we're going to talk about that as well. Well, I was going to say that the specified price that you actually set, like take for instance, when you saw my example of Himax, I had a call for $14. That is what they call the strike price. That $14 is what they call the strike price. So that's very imperative. Now, we also need to understand that call option may be purchased for speculation or sold for some income purposes. So a lot of people I know who do large call options and put options, they use this for their income. This is how they get paid. This is how they get paid each and every month. Okay. So with that being said, the market price of a call option is called the premium. I say again, the market price of a call option is called the premium. Now, this is the price that pays for the right that the call option provides. Now, if that underlying asset is below the strike price, the call buyer loses the premium paid. What does that mean? So right now, I have a call of $14 and you see my profit you see the cost of this option was $4.90, but my market value is $4.30. So right now I'm losing what? $60. Again, the market price of the call option is called the premium. So if this expires below the call price, then my option expires out of the money. Because even if we look over here, it says Himax break even point for these particular two options is $16.45. And this is why I have a long option till September 17th. Because we also need to understand that the theta The theta right here is an analytical indicator of how time decay will play a role in the deficit and loss of profits as this stock begins to get into essentially the last month of its birth. This is how time decay takes away profits. I have been a victim of time decay time and time again by buying risky options within the month. I do not advise you buy an option that expires within the same month. At least 3 months should be your token. There's a lot of stocks out there that you can buy at a very low price point that has large potential for growth, large potential for profits. Now, if the underlying price is above the strike price, okay, if the underlying price is above the strike price, when it expires, the profit is the current stock price minus the strike price and the premium, meaning you have to subtract to see how much profit you actually incurred because of you exercising that option. Now, this is multiplied by how many shares the option buyer actually controls. Very imperative. Now, some investors use call options to generate income through which they call a covered call strategy. Now, this strategy involves owning a stock while at the same time writing a call option. Okay. And someone asked me, they say, Ross, why didn't you write a call option? Why didn't you cover your call by writing a call option when you lost that 10 grand with Tesla? I said, when you really look at the prospects of it, that the prospectus of it, that I would have been losing if I didn't go one way. Meaning if I just didn't have an option waiting for that, essentially that option to gain in value and profit, meaning that the stock price, which is located here, went above my call price, then covering calls is essentially what they say is insurance for your option, but it's almost sometimes more times than not that you're betting against yourself. So sometimes covering your option is a great thing, but you can actually lose. But more times than not, people who are writing options and covering their calls, they make more money. They do make more money because they're not incurring as much risk. And a lot of you may want to even get into, writing option, because writing an option refers to an investment contract in which a fee or premium is paid to the writer in exchange for the right to buy or sell stocks at a future price and date. So put and call options for stocks are typically written in lots, which each lot represents 100 shares. So essentially, when I showed you that price for $1.20, and I say it's times 100, because that's the amount that these people who write these contracts for options, each option contract is 100 shares. Now, that doesn't mean you have 800 shares of that particular stock, which means is whether you exercise your option to sell or to buy those stocks at your call price. Let me say that again. I want to make sure everybody understands that. So when you are doing option trading, there's a lot of things you can do with options, okay? And we're mainly trying to focus on call because, again, this thing can go all day. When you put in an option when you pull in a call option, and mine's right here are listed at $14 a call. Now, at a particular point in this option contract, you have the ability, you have the right to exercise this option and buy 100 shares of Himax at the call price or at the price that you specified when you bought the contract. One. Number two is you have the right, but not, you don't have the obligation, but you have the right to sell your option at profit. Meaning when this particular stock hits $14, any dollar amount after that, you will see my total return turn positive, which is profit for me. And then before September 17th, I can actually sell this option and just run away with the profit and buy none of the shares. This is my method. And I think I'm gonna start getting into writing options and covering my calls, because I'm getting to the point where I was doing really well. I made over 10 grand doing options. And then now I'm almost to the point where I'm breaking even. Okay, because I was up 20 grand, I lost 10 grand, and now I'm breaking even. So I think I need to be a more safe option call investor. I'm not really into puts, even though I believe you can expand your portfolio if you implement call and put options. I believe that's very important. Now, we need to understand that traders write an option by creating a new option contract that sells someone the right to buy or sell a stock at a specified price, which is the strike price, on a specified date, which is the expiration date. So in other words, the writer of the option can be forced to buy or sell a stock at the strike price. However, for that risk, the option writer receives a premium that the buyer of the option pays. This is where the money comes in for covering your calls and being the writer of the option. The premium received when writing an option depends upon some factors, including the current price of the stock, when the option expires, and other factors such as underlying assets, which is called volatility, which I speak about this all the time. This is very important because the benefits of writing an option, some of the main benefits of writing an option is you receive money immediately, which is your premium. Premium is received immediately. Okay, as soon as they sell an option contract, because essentially instead of you going buying contracts, you're the one writing the contract. And when you do that, and when somebody buys your contract, you get a premium. Also, keep full premium if the stock expired out of the money. So again, I go back to my Tesla example. When I lost out on that option, whoever wrote that contract got my 10 grand. And that's why there's a lot of millionaire option traders, because they took my 10 grand. So they keep the full premium. They keep all the money when your contract expires out of the money. I mean, if the option expires out of the money, meaning that your stock price closed below the strike price for the call option or above the strike price, if we're talking about put option, then the writer of that option keeps the entire premium. They keep the entire money. Now, as I told you before, time decay is one of the worst killer of any contract. Of any option contract, time decay is one of the worst. I've been a victim of time decay too many times for me to even give you a number. I mean, options decline in value due to time decay. Options decline in value due to time decay. Now, time decay reduces the options writer's risk and liability because the writer sold the option for a higher price and has already received a premium. They call it buy it back for a lower price. See, and that's what I mean, that you could double lose or double win when you cover your calls. And that's one of the things that most people don't want to really mention. They just like, oh, covering your calls is always a good thing because you're going to win more times than not, which is absolutely true. But you can absolutely lose as well. Because again, the writer sold the option for a higher price and has already received their premium. So if you're the writer of the contract, once you write it and somebody buys your contract, you receive your money. But then you can buy it back for an even lower price and then resell it. So all of these transactions, all of these trades, you are incurring money. You are incurring profit. Now, we need to understand that you have a lot of flexibility. I mean, an option writer has a flexibility to close out their open contracts at any time. The writer removes their obligation by simply buying back their written option in the open market. Now, there are some risks of writing an option because, I mean, even though an option writer receives a fee, or premium for selling their option contract, there's a potential to incur loss. I mean, take for example, let's say that Daryl thinks that Apple shares will stay flat until the end of the year due to a lost launch of a tech company iPhone 11. And then he decides to write a call option with a strike price at 200 that expires on December 20th. Unexpectedly, Apple announced that it plans on delivering 5G capability iPhones sooner than expected, which is always great news for a company and a stock. And the stock price closes at 275, not at 200, where you actually wrote the call option at, but at 275. So on the day that the option expires, Daryl still has to deliver the stock to the option buyer for $200, meaning he will lose $75 per share as he has to buy the stock on the open market for $275 to deliver his option buyer for $200. So, I mean, losses on writing an option are potentially unlimited if the option is written naked. I mean, there are no other related positions. If, however, somebody writes a covered call where they are already long on the stock, the losses in the call that are sold will be offset by increases in the value of the shares owned. So, yeah, I mean, it's profitable to write an option, sure. And I'm going to get into that personally on my own, because that's a whole nother can of worms that I haven't even opened up yet. Now, some investors use call options to generate income through a covered call strategy. Now, this strategy involves owning an underlying stock while at the same time writing a call option. And we need to understand that this strategy generates additional income from the investors, but also has limited profit potential if the underlying stock price rises sharply. That's the exact thing I just explained. Now, covered calls work because if the stock rises above the stock price, the option buyer will exercise their right to buy the stock at the lower strike price. This means that the option writer doesn't profit on the stock, moving it above the strike price. The option writer maximizes profit on the option is when the actual premium is received. So that's where the money in writing an option or covering an option is when that writer, if you became a writer of option, when you sold that contract to the buyer, you receive a premium up front. That is where the real money is. But other than that, you could win-win or you can lose-lose. So take that with a grain of salt. Very important that we understand how these options actually work. Because, again, I have been a victim of losing thousands of dollars of buying call options within the same month. And if you do that, you're going to be a victim of time decay. So let's not even talk about the writer of the contract itself. I'm going to be a victim of time decay. All right. Let's see what you guys are talking about out here. Let's see if you have any questions. We said, seeing, appreciate this, God. Okay. We got investing out. I don't know how to pronounce your name, brother. My apologies. I'm just going to call you investing. We got Mitchell Liggins from Alaska. We got Prime X. Good morning. See, Prime X says, please explain a warrant and the difference between that and an option. Thanks. And the car carpenter, good morning. Prime X, I'm about to leave that for a different video. My apologies. I want to stay on task because when it comes to option trading, you know, you got covered calls, you got writing option, you have puts, you have calls, and some of us is still trying to get around doing a call option or put option, you know. So with that being said, I think it's imperative that we understand that time decay is probably one of your worst enemies ever, because time decay is a measure of the rate of decline in the value. Okay. Let me know if you guys understand, but time decay is a measure of the rate of decline in the value of options contract due to the passage of time. Time decay accelerates. Listen to this. Time decay accelerates as an option time to expiration draws closer, since there's less time to realize a profit from the trade. What am I saying? Basically, what that means is the closer we get to the expiration date of an option, the less likely, less potential you have to make any profit on that option. Because time decay is also called theta. Didn't I say that before? It's called theta. Let's look into it. Look at the Greeks. Here's the Greeks. So let's look at this as I'm explaining this to you guys. So this is called the theta. Now, all of this is called the Greeks. You got delta, gamma, theta, vega, rho. But when it comes to the time decay, this is most people look at the theta analytical tool versus any other Greeks. Okay, and this is what people use for options to understand it, because other Greeks include a delta, gamma, vega, and rho. These formulas help you to assess the risk inherent with an option trade. That's why you won't see this on regular stocks. You won't see none of this on regular stocks. This is only on option trading that these are keys for you to essentially help you predict what your option is going to do. But again, time decay. The reason why I have to beat this across the head, because even though you can cover your calls, be a writer, this is the problem that most novice, beginner option traders get into is time decay. They try to hold on to their option, but all the while, the closer you get to the expiration date of your option, and again, the expiration date on my option is September 17th, but the closer you get to that date, theta and these other Greeks will give you an indication, say, hey, this is the best it's going to get. You're either going to sell or you're going to spy out the money. Let me tell you something. Never take my experience, take my stupidity as your wisdom, meaning learn from other people's mistakes. Do not have that option to expire out of the money. If your option, if you waited to the last day prior and said you're only going to essentially make $3 off that option, but you lost $300, sell that option and get your $3. I have done that more times than not, where it's only $3 or $4, whatever. But time and time again, 3, 4, I could reinvest that money and recruit maybe $30, $40, $50. This is a side note. Time decay is the reduction in the value of an option as the time to the expiration date approaches. I mean, an option time value is how much time plays into the value or the premium for the option. The time value declines, time decay accelerates as the expiration date gets closer because there's less time for investors to earn a profit from the option. And these are the indicators. Now, again, breaking down the Greeks is another long video because there is some algorithms, there's some mathematical probabilities that I would definitely have to depict and break down for you guys to totally understand how to use the Greeks in your advantage. But this should not be ignored. Most people look at the profit, they look at their return, while you should really have your eye on the Greeks, because this is a great indicator and analysis tool for you to understand. One thing I failed to mention early on when I started talking about options, period, the implied volatility is a great indicator in both ways when you're buying an option. There's an 80% chance that this stock is going to hit the call price, or there's an 80% chance that it won't. That's the problem I have about implied volatility. But more times than not, I like to use implied volatility as a tool to let me know that the trajectory of this stock will reach this call price. So right now, as I'm looking at this stock is at essentially $13. I have until September for the stock to reach $14. I have a good chance. Hopefully Himax does something phenomenal here in the next couple of months, and then I can make my money back. But nonetheless, there you have it, ladies and gentlemen. I see you guys are commenting, but that's all the time I have for this morning. Let's see here. Investing says, yeah, I buy all my options out for at least a year and use to gain more shares of companies I like. So investing, he uses the options to actually buy the shares at a lower price point, even though that they are accumulating value. Where me, I buy options, and when I see a profit of, times 5 times 10. I sell that option. They can have that option. I just want the money because this is how I pay myself. So take that with a grain of salt. Hopefully this video has enlightened you on some ways about call options. Nonetheless, I think that maybe in the next week, 2 weeks, I'll talk about put options. But basically, put options is the exact opposite of call options. Call options, you have a call price that the stock is going to go up to. A put option is a price where the stock is going to go down to. So one quick example before I get out of here, I go to Hamex. If this said a put option, if this said put right here at $12, then I will start making profit once this put option reached $12. That's basically it. That's basically it. Right now it's at $13. I say Hamex put option at $12. So whenever Hamex would drop down to 12, that's when I start to make money. That's simple. Of course, always include time decay. Never, ever in your life when it comes to option trading, forget time decay. It is your worst enemy, not the writer of the contract. It's time decay, I assure you. This is Financial Literacy 101. Learn money and be inspired. You guys have a great morning. I'm out.